Guys, ladies and gentlemen, I'm about to start the second session of today. I hope everybody's ready, had a cup of coffee, maybe a technical break, whatever you required, and you are ready to listen to me for another 30 to 40 minutes in this second session of today. So I already saw that there are a couple of questions coming in, guys. Really good questions. No worries. As I promised you guys, I will take whatever time it requires after the last session of today, after the third session of today. I will take my time and answer the most relevant questions. But I saw already some of the questions that I'm most likely going to answer right now in this session and in the third session. Okay, so stay tuned. I'm about to start. I assume you can hear me. If you cannot hear me, if you don't see the screen, just let me know, but I think everything should work fine. So let's get started right away. So let me get started the second session, and let me quote George Soros. I hope everybody knows George Soros, right? He's an American investor with a net worth of 8 billion US dollar. Okay, 8 billion US dollar. He's very big, a very big American investor. So let's quote him. He said, "It is not about how often you are right or wrong, but it is all about how much money you make when you're right and how much you lose when you're wrong." So let me get something straight right from the get-go here. Your win-loss ratio, your winning percentage, however you want to call it, your win-loss ratio is of zero significance on its own. It does not have a finite role to play in deciding how efficient a trading and investing system is, or how good you as a trader are, right? It has nothing to do with your win-loss ratio or winning percentage. It is still, ladies and gentlemen, it is still quite possible to lose money with an 80% win rate if you fail to manage your losses well. However, you can always be profitable with just a 30% win rate if you have mastered how to let your profits run and cut your losses short. So George Soros' concept boils down to one thing: your risk to reward ratio. So let's now look at two different scenarios. Okay, before we get started with some number crunching, let's quickly re-emphasize on the core concept that allows us to audit our decision making and performance. KPIs, so our key performance indicators, are only the result of the set we place. What is that again? Stop entry target, right? Our KPIs are only the result of the set we place. Without a set, we cannot measure our performance. All right, so let's assume in scenario one, you're planning to buy a stock, whatever it is, right? An asset, right? You're planning to buy an asset at $20 per share. Stock $20 per share. This could be, guys, this could be currency pair. This could be a commodity. Based on this example, just to simplify it, we have round numbers, and I don't want to overwhelm you now with currency, with a couple of digits on that screen. So let's keep things very simple here. So, but the concept is always the same regardless of asset class, okay? So you're planning to buy a stock at $20 per share. You place a stop loss at $18 a share. You see all these numbers on the screen, and the target at $30 per share. Now price comes into your buying zone. Let's call it buying zone. Price spends some time in the buying zone, and finally price moves out of the zone right into your target. The question is not how much profit you made on this trade. That's easy, and in general profit is always good, right? No doubt about that. Profit is always good. But the most important question here is, guys, how much profit you made in relation to your risk. In other words, what is the risk to reward ratio of this trade? If prices were to fall, we set a stop loss, right, to manage our risk. So the risk is measured from the entry. Let me see, this should come here now as well. Yes, the risk is measured from the entry to the stop loss, which is also the area highlighted with the yellow box. The delta between the $20 entry and the $18 stop loss is $2, right? This is your risk size based on the trade parameters. But the actual dollar amount risk you take on that trade is not fixed on that amount. Rather, you can view this as 1 or X, meaning it is a variable. You determine the dollar amount risk size yourself. That's the beauty about trading Forex and futures, futures as well to a certain extent. Let me say CFD futures. Again, there's a clear differentiation between futures and CFD futures, stocks, CFD stocks, Forex, trading gold in the Forex market, in the spot market, and so on. We don't want to go into these specifics because they are rather complex, and it would take me more than one single webinar to explain all the variations of what you can trade. But in general, we are here in a Forex webinar saying the beauty about Forex is that you can always determine the dollar amount risk size yourself. So this is your 1, your X, right? It's a variable. You define it yourself. So hang on, it will make sense in a second, okay? So just stay with me. So the dollar amount risk can be literally anything. You could risk $10, right? And by the way, I think I've seen a question, something like, can I make profits with $5 or something like that? It doesn't make a difference whether you trade with a $20 account or a $20,000 account. You define your risk yourself. If you have a $100 account, well, then you might take only $5 of risk. That's fine. It's the same thing. Then you take a $20,000 account and take $500 of risk. You are always able to define in the Forex market. You always are able to define your risk yourself, the risk you want to take. So you risk $10, you could risk $100, you could risk $1,000, or you could risk $1 million with this zone parameters. It is a way of using calculated risk. You know exactly how much you're willing to lose, and this can be predefined in the set stop entry target you place. So for the sake of this example, let's say here in this case, you risk $1,000. Okay, that's your risk. Let's have a look if the reward was good enough for us to take the trade. The reward is measured from the entry to the target. The delta between the $30 target and the $20 entry are $10. So what was the profit in relation to the risk? $10 of rewards versus $2 of risk. If the $2 risk is one, then the reward in this case is 5. This means that for every dollar, for every dollar you risk, you make $5 of pure profit. What would a risk to reward ratio of 1 to 5 look like for you as a professional trader taking a predefined risk of $1,000, right? The math is now really simple. Everybody can do that. 5 times $1,000 equals $5,000. Another example, if you risk $50 in this buy zone, your reward would have been 5 times $50, so $250 of reward. And the gentleman who asked if he can make profit with $5 of risk, well, he just takes $5 here in this buy zone as his variable, so he makes $5 times 5, so he made $25, right? You define your risk yourself. So solid, right? Let's look at the second scenario. Ladies and gentlemen. Here I changed, and now something you should remember. You should remember one thing that we discussed in the first session. I'll stress this in a second. Here I changed only one parameter, the entry. Right? You see that. You see the difference, right? You see the difference. I have an awesome idea now. Why don't we wait for price to rally first before we get in? That way I will have more probability, right? Take a second to think about this scenario. Do you agree that this would be a good idea, what I just said? Hopefully not, because what I just said doesn't make sense. It's wrong. What I want to show you is how changes in your set stop entry target parameters can have a big effect on the outcome of the trade in terms of risk to reward. You missed the entry at $20 because you waited for price to rally. Now you see that price rallies, you start to chase price and enter the asset at $24. Keep in mind that target and stop loss remain unchanged. They are placed as per your rules, as your predefined rules. What happens to your overall risk to reward ratio now? It changes drastically. I hope everybody can see that. The risk to reward ratio changes drastically, but not in a good way, because now for every dollar you risk, you only make $1 of reward. So consequently, your risk to reward in scenario 2, your risk to reward in scenario 2, as you can now see here fully unfold, is 1 to 1. Or speaking in actual dollar amount, let's take the same risk you decided to take in scenario 1, $1,000 per trade, instead of making now $5, instead of making $5,000, example on the left, you only make now $1,000, example to the right? Only because we changed one parameter, and this is the entry parameter, meaning we chase price. And you might remember in the first session we said, we as professional traders, we never chase price. We wait for price to come to us. Only novice traders chase price. So now you might argue, hey, Bernd, but what about probability? You know, profit is profit. I'm happy with $1,000, right? We are all happy. So and that's you have a point. You have a very good point. But let's evaluate the two scenarios, scenario 1 and scenario 2, more in detail. Now here to the left, let me not yet fully unfold it. So let me slowly get started here, so you can follow the entire slide. Now here to the left, I have trader A, who takes only trades that have a profit potential, you can see it, with the risk to reward ratio that is bigger or equal than 1 to 5. And according to his business plan, right, trade plan, we're going to talk about this, very important. Every trader has to have one. If you don't have one, don't trade. You will never become consistently profitable. He takes $1,000 per trade, right? That's based on his, this is based on his trade plan. He takes only trades that give him a risk to reward potential equal or bigger than 1 to 5. And according to his business plan, he takes only trades he takes $1,000 risk per trade, right? Consistently. So now trader A, let's assume he takes 10 trades. First trades, he loses. How much does he lose? You should all be able to answer this by now, right? He loses $1,000 because it's always predefined risk. He predefined his predefined calculated risk, not more, not less. That's his one, that's his X, that's his variable, right? $1,000. Second trade, he loses again, another $1,000 lost. Third trade, he loses as well. Oof. Now 3 trades down, $3,000 down. Let's look at the fourth trade. The fourth trade is the winner due to his stringent rules of only taking trades with a risk to reward potential of at least 1 to 5. He now makes $5,000. So trade number 5, he loses. Trade number 6, he loses. But trade number 7, he makes another profit, and this time his trade generates a 1 to 7 risk to reward ratio. So he banks in 7,000 in pure profit. Next trade, he loses. The 9th trade, he also loses. And the 10th trade, he achieves a 1 to 6 risk to reward ratio, banking in another $6,000 of profit. So let's assume these were his quarterly results. Just like any other business owner, also trader A evaluates the performance of his business based on a simple P&L, profit and loss calculation at the end of each quarter. So let us do that quickly. His profits are $18,000, right? So 5,000 plus 7,000 plus 6,000. I mean, I hope I don't have to do the math for you. That's simple math, right? And his losses are $7,000, right? He lost 7 times, 7 times $7,000. So overall, a solid and profitable P&L of $11,000. In other words, trader A made $11,000 in this quarter. And looking now, and this is now, it's even more important, and looking at its winning percentage or win-loss ratio, he had 3 winners and 7 losers. So overall, a 30-70% win-loss ratio. So he lost 7 times out of 10 trades and made profit 3 times out of 10. So he has much less winners than losers, but he is quite profitable, right? So now let's look to the right and examine what trader B does. Trader B has an average risk to reward ratio of 1 to 1 on his trades. And trader B takes the same dollar risk amount, $1,000 risk per trade. Trader B also takes 10 trades. I'll quickly just unfold everything, right? So you see it, you get now the concept. So trader B also takes 10 trades, and as you can see, he has a very, very high winning percentage. In fact, it's 80% winners and only 20% losers. Wow. And when he loses, he also loses only $1,000 per trade. But when he wins, since his average risk to reward ratio is only 1 to 1, he only makes $1,000 per trade. So if trader B is looking at his quarterly quarter results, he generated $8,000 in pure profit. On the other side, had $2,000 in losses. So consequently, overall on his P&L, he made $6,000 in profit. So let's compare the two. Who has the better performance? Trader A made $11,000 and trader B made $6,000. So it's clearly, right, you guys see it, easy math. Trader A has the much better performance, although he has the much worse win-loss ratio. So what we can derive from this example is that risk to reward ratio is the key KPI, key performance indicator, is the key KPI for all. There are no two opinions here, for all professional traders and investors. And win-loss ratio has no or only little impact on a trader's performance. Now, you could still argue, and some of you might, you could still argue, well, I'm happy if I can achieve trader B's result, because yes, he is still profitable. But now, guys, let's go one step further. Let's examine if the win-loss ratio the trader B achieved in my example here, the 80-20, is a realistic number you can achieve in the trading arena. Okay, now guys, this is so important, this teaching point. Let's look if this is some nonsense or if this is some realistic number everyone is able to achieve. So please listen carefully, guys, super important. This is a screenshot from Goldman Sachs. Goldman Sachs, I hope you know, right? Annuals report 2018. You can check it out yourself. There's the source I stated here on the slide. You can check it out for yourself. Just Google Goldman Sachs annual report and you'll find it. This is not classified information, right? So this is amazing. So let me now talk a little bit let me zoom in a little bit here for you to see these stats, okay? Because they paint the picture pretty well. Let me explain. See, right here where it says daily net revenue, maybe let me see if I can, most likely, let me use my laser pointer here. So here, so where it says daily net revenue, these are the actual daily trading net revenues from their own trading desks. Goldman Sachs trading desk, their own trading desk, trading with the bank's money. Have you really believed that Goldman Sachs trading strategy is buy and hold? No, they don't buy and hold. They actively trade. They actively trade on a weekly base, on a daily base. This right here is showing you how many profitable days Goldman Sachs had compared to losing days. So they had 31 losing days. So nobody's perfect, right? But very close to perfect. But look at their win-loss ratio. I'm looking at their annual report, guys, myself. I'm doing this exercise every single year because it's just so astonishing to me. I'm looking at their annual report every single year since 2013, and they are always consistent in their results, having a winning percentage of around 80 to 85% every single year. So, guys, this is Goldman Sachs. This is without doubt the most powerful and most influential bank in the entire world. Half of Trump's team consists of former Goldman Sachs employees. Also, Draghi, former European Central Bank president, was a Goldman Sachs employee. If they are winning around 80, 82, 85%, doesn't matter, around 80% of their trades, how can we as retail traders expect to have a similar statistics than them? Guys, if you still believe that's possible, that's very naive. It's impossible, right? Having similar stats than Goldman Sachs is just impossible. Secondly, if you know that they are going to win that many times and lose only a few times, then this tells you that there must be someone, well, a lot of someones on the other side of all those trades. Because why? I'm not sure if everyone was here with me from the very beginning. What did we discuss? What was one of our findings? Trading is a zero-sum game, right? So rhetorical question to you guys. Would you ever want to be buying? Would you ever want to be buying when Goldman Sachs are selling, or selling when they are buying? Hell no, because if you are on the other side of them, you're losing when they are winning. Instead, you need to know exactly when they are buying so you can buy it along with them on the same side. You understand right here, guys? You understand here on the right when they made. This is in millions, net revenue in millions. When they made 75 million plus dollars, 75 million plus dollars on 90 different days, 56 plus 22 plus 12. So they made $75 million on 90 different days. This is a net sum zero game, which means that money came from somewhere. It's not growing on the trees. Money is not raining. It came from someone else's account. So where did that money come from? Did Goldman Sachs take all the money from JP Morgan and the Bank of America? Or it is coming from the people who don't know what the heck they're doing, right? It's coming from the people who don't know what the heck they are doing in the financial market. So I hope this was, let me remove my laser pointer and move on to the next slide. Another lesson here is that you have to keep your risk constant, guys, right? We will talk about this piece of the puzzle later on in our milestone planning lesson. Also, milestone planning, I'm teasing since the very beginning, we do in the last session of today, right? But one common mistake that I see a lot with novice traders is that they vary their dollar risk depending on the result of their last trade outcome. Novice traders, right? So beginners, amateur traders, however you want to call them, tend to either increase their dollar risk after each win or reduce it after a loss. This is entirely, guys, ladies and gentlemen, this is entirely emotional and isn't advisable at all. The performance example here on this slide explains, you see it here on this slide, the performance example here on this slide explains how a trader can win close to 80% of their trades and still lose money. Although we just learned, right? And again, there are no two opinions. We learned that 80% is not a realistic number for us to achieve in the long run. Yes, once in a while, during a small period of time, during a month, during 2 months, we can have these stats, but we are talking long run, right? Impossible. So to do this is a huge mistake, since your next trade outcome has no correlation with your previous trade. You should always keep your risk steady and stick to your predefined plan, and only increase your risk once your business plan, your trade plan, we talk about this in the next session, allows you to do so. But the sad thing, guys, it's really sad, I find it sad at least, is that the result of this trader, of this hypothetical example, so to say, is somewhat familiar to a lot of novices, to a lot of beginners. They allow their losses, they basically, all these beginners, they allow their losses to destabilize them and let things get out of control. The goal is always to ensure that your losses are small relative to your wins. So the primary lesson here is the fact that just 1 or 2 losses, that's the primary lesson on this slide. The primary lesson here is the fact that just 1 or 2 losses, if not well managed, can still lead to a significant loss, right? And the numbers here, guys, are just placeholders. You could add any number here. I think I just want to convey here the principle here. So to cut to the chase, the formula to success is quite simple, but it's not easy at all. Okay, you must utilize proper money management principle, and this only works if you're an extremely skilled trader who can achieve high risk to reward ratios, right? High risk to reward ratios on a regular basis. So overall, I want to stress, again, we talked so much about money management. I want to stress that money management is only one of many skills you have to master. It's an important one, yes, of course, no doubt about it, no doubt about it, but it is only a tool. Remember, guys, the car analogy that I made in the beginning so extensively, we made in the first session of today. An airbag, right? We talked about an airbag. An airbag in a car doesn't prevent an accident. It only increases the probability for you not to get badly injured in case you have a car accident. The things that you have to be skilled in as well are finding these areas where banks and institutions are very likely to buy and sell and position yourself alongside with them. Finding low risk, high reward, and high probability trade setups. Only then you can make use of your money management tool and fully benefit from it. So, guys, let's examine following case. So I want to make now a small case study with you guys. Okay, really quickly. I just want to check the time that we have up. Yeah. However, yeah, it doesn't matter, right? I mean, I'm here for you guys today. So if we exceed time a little bit, it doesn't matter. So I think it's valuable for you anyway, right? So let's examine the following case. So the ability to maintain, so this is the case, right? Let's make the case here. The ability to maintain an average risk to reward ratio of 1 to 2, taking into account only winning trades, combined with a 40% winning ratio, allows us to continuously and consistently grow our accounts. Okay, so as simple as it gets. We take into account that our person is a multi-asset trader and investor, and he or she takes $500 risk per trade. Again, guys, it's only a placeholder. You could take literally, you could replace the $500 with $5. You could replace the $500 with $50,000. It doesn't matter. It's just what we want to showcase. You have to keep the risk constant. So in this case, just $500 risk per trade. Again, use your number you want to start off with, and that's the number you're going to use. So well, let's say I have even a better idea. Let's assume this trader in our case, right? In our case study, that's you. Okay, let's assume this is you, right? So let's assume that's you. Let's start with a sample month here, guys. Let's start with a sample month. So you take 10 trades in 4 weeks, right? You have week 1, week 2. You see it in the upper column, right? And you have the days: Monday, Tuesday, Wednesday, Thursday, Friday. Very simple, very simple. You take 10 trades in 4 weeks. That's, for me personally, a reasonable average if you focus on what we call weekly and monthly income, and taking into account that you are a multi-asset trader, trading and investing maybe in the stock CFD market, CFD futures, maybe trading also real futures, and of course Forex, right? So sometimes you might have a little bit less trades in a month, sometimes a little bit more, but this is 10 trades in a month. It's a very realistic number if you're picky, right? So let's look at week 1. Okay, in week 1, you have 1 winner and 2 losers. And please keep in mind, each winner is a 1 to 2 risk to reward ratio. So overall, you had a week that was break even, since 2 losers are leveling out your winner, right? A break even week. In week 2, you had 1 winner and 1 loser, meaning you made profit of 1 at the end of the week. In week 3, you had 3 losers and 1 winner. So that's a very realistic case study, guys, because it shows that as a trader and investor, as a business owner, you cannot make money every single day, and you cannot make money every single week. You might have break-even weeks and you might have losing weeks, but it's about the overall. It's always about the overall average. Remember, you're a business owner, and at the end of the month, you look at your profit and loss statement, your P&L, or at the end of the quarter or at the end of the year, and compare your profits with your expenses. So bottom line, in week 3, you are down by 1, you're negative. In week 4, you have only 1 trade and you have a winner. So at the end of the week, you made 2. So looking at the entire week, you had 10 trades. Out of the 10 trades, looking at the entire month, you had 10 trades. Out of the 10 trades, you had 4 winners, so 40% winners overall, and 6 losers, so 60% losers. Hence, your win-loss ratio is 40-60. If you look how much profit you made, you were break even in week 1, week 2 is balancing out with week 3, and in week 4 you made 2. So overall, you have a profit of 2, right? So that is your average. That's your average trading month. Makes sense, guys? I hope, ladies and gentlemen, this makes all sense. Well, then let's put some real numbers now behind that sample month. As we said in the case study description, let's assume your risk per trade is currently $500. I hope by now it's clear that we cannot play around with our risk factor. Our risk is always 1, meaning we have to keep our risk constant. The risk variable must be a constant. That's very important. So $500 of risk. Week 1, as you remember from the previous slide, you had a break-even week. So bottom line, zero-sum game for you. Week 2, you made 1, so overall you made $500. Week 3, you're down by 1, so you lost $500. You have losses, right? But they are all controlled. All your losses, they don't spill out of control, they are controlled. And in week 4, you made 2, so you made $1,000. If this is now your P&L, at the end of the month, you had a monthly return of $1,000. So if you can accomplish this result month over month, this means you are consistent in your trading and investing approach. Consequently, you're consistently profitable. In other words, if you can achieve this over a period of 12 months, right, your yearly return would result in $12,000 US. However, now guys, if you are consistent in your approach month over month and you feel comfortable with taking $500 of risk, again guys, remember, I know $500 might sound a lot might sound a high number for some of you. Doesn't matter, it's a placeholder. Replace the $500 with $5. I don't care. It's the same principle that we're talking about here. It's always about the principles. The numbers are just placeholders, right? Please understand that, right? So taking $500 of risk, why not increasing your risk after, for instance, the 3rd month, and scale up your business and give yourself a raise? So let's scale up our business and give ourselves a raise. So let's do that. Let's do that on the next slide. So what you can do now is simply give yourself a salary raise, right? You want to scale up your business by taking more controlled risk, guys. Controlled risk. You increase your risk variable. The way how you place your set, the entire process never changes regardless of your risk. The only variable in this entire equation that changes is the risk you're going to take per trade. So if you're now consistent in your approach, then you can increase from, let's say, $500 risk per trade to $1,000 risk per trade. The only question that remains is, how comfortable do you feel taking $1,000 risk per trade? So in other words, the mental side of the game, and that's why we have to slowly together, right? You and me now, we have to get you to become used to these bigger numbers, because let me tell you, out of my own experience, right, this makes a huge difference mentally. So by taking by taking $1,000 risk per trade, taking into account the same sample month, because you are consistent, your monthly return would now increase from $1,000 to $2,000. And since you're consistent in your approach, if you can do this month over month, our yearly return would be $24,000. But if you can do this now again, for instance, over a period of 3, 4, 5 months, why not again giving yourself a salary increase and scaling up your business? So let's do this again. Again, numbers, guys, numbers, placeholders, right? Don't get intimidated by these numbers. These are placeholders. Add your personal number, right? So I hope you slowly now understand the concept behind this now. Because what do you have to do? What do you have to do to increase your salary and to scale up your business? What do you have to do? The only variable, guys, in this entire equation of trading that you have to change is what? Think about it. I give you a second. The only variable in this entire equation that you have to change is what? Your controlled risk, right? You have to increase your one, your variable, your X. So now let's increase your risk from 2,000, where you felt maybe comfortable now with, and traded consistently profitable for a longer period of time, and increase it to 3,000. What happens to your monthly return, taking into account a similar sample month? Your return would now increase to 2,000 a month, from 2,000 a month to 6,000 a month. Again, if you're consistent in your approach and you have done this with $500, with $1,000, with $2,000, excuse me, well, then you should be able to do this with $3,000. And if you do it for a period of 1 year, your yearly return would be $72,000. So now let's do this one more time and give yourself a raise. In reality, guys, right? In reality, of course, you can do this as many times as you want. In a financial market, that's again the beauty about trading. In the financial market, guys, there is no ceiling for us as a retail trader, of course. If you do this a couple of years and you gradually scale up your trading business, then it doesn't make a difference whether you trade with $7,000, $8,000, or $10,000 of risk. It took me, for instance, I can openly talk about it. I can openly talk about it, 5 years to get to that stage here. I personally think it's more than worth it to work 5 years hard on your skill, on your craft, to be at this stage of your business. So what was the whole teaching point on this? Well, first of all, trading and investing is the only business in the world that I know of where if you want to make more money, you don't have to put in more what? Think about it. Trading and investing is the only business in the world that I know of where if you want to make more money, you don't have to put in more time, right? You don't have to put in more time. You want to make more money in real estate, you've got to get more projects, more people, more teams, more time. You want to make more money in your physical business, it could mean more inventory, more employees, more processes, more time. But you want to make more money here in trading, it takes absolutely no more time. It takes just only more what? Money, right? As you make money, you have more money. As you have more money, you can trade with more controlled risk. And as you trade with more controlled risk, you make more money. And it's the same amount of time. In this entire equation, time is never a variable. Time is not a variable, guys. So, and money can be anything, right? Money, we just talked about this. Money can be literally anything if you're able to maintain a proper average risk to reward ratio in conjunction with an adequate win-loss ratio. But there's a catch, right? What is the catch now? There's always a catch. The catch is that you have to become consistently profitable in your approach. And the only way how you reach a level of consistency is by being black and white, objective, and fully rule-based. So I hope this makes a lot of sense to everyone. I really hope this makes a lot of sense to everyone. And this is actually a very important concept that today, right, where we start off building the foundation. Today we are building off, starting to build this foundation of yours. This is one of the most important concepts that I got to get across, right? So to measure now, this is the last slide now. That's the last slide for the second session of today, and then we have another 10 minutes break. So to measure consistency, we said we need a combination of two KPIs, right? Key performance indicators. What are these two KPIs? Your average risk to reward ratio in conjunction with an adequate win-loss ratio. However, your risk to reward ratio is weighted much higher here, right? In reality, you could even have 30-70 or 20-80 win-loss ratio if your risk to reward ratio exceeds 1 to 3. And if you ask me, that's where I'm actually my personal trading is my personal trading. My risk to reward ratio, my personal risk to average personal risk to reward ratio exceeds easily the 1 to 5, but my win-loss ratio is also not near 40-60. It tends more like 30-70, but you see what numbers you can achieve if your risk to reward ratio is high enough. But there's obviously a minimum you should achieve. And if you achieve that minimum of an average 1 to 2 risk to reward ratio and an average win-loss ratio of 40-60, then regardless of risk, right? $5, $500, $5 million. You take $500 or $1,000, you are highly profitable. If you are here, if you meet these two criteria of combined KPIs, of course, risk to reward ratio weighted much higher than win-loss ratio. So bottom line, this is what you have to measure yourself with. This is where you basically measure yourself, your measurement for as a professional trader. That's it, guys. I would say another 10 minutes break. It's here in Dubai, it's 1 p.m. So I think in Kenya now it's 12 p.m. So it's lunchtime, guys. Let's have a technical break, another 10 minutes break. So we come back in 10 minutes. Okay, guys? See you in 10 minutes.
Thank you, Bernd, so much. You can have your 10 minutes, definitely have something to drink. But for all the webinar attendees, we promised to book 5 prizes at this webinar. So it's time to do that. So how are we going to determine the winners? I will be asking 5 questions. Whoever is the first to type the correct answer in the webinar chat box in $100 live trading account with FXPesa. So I'm just going to give you 10 seconds just to get your chat boxes ready. Okay. The first is, if your predefined risk in a trade is $100 and your risk to reward ratio is 1 to 5, what is your reward in US dollars? Wow, you guys are really... All right, and the winner is James. James, we'll be getting in contact with you. Okay, let's go to the second question. Which of the following poses a higher risk? Is it Ferrari or its driver without the license? Okay, that's so many answers. John, you're the winner. John, we will be also getting in contact with you. Let me just, okay. Let's go to the next question. So if your win to loss ratio is 50 and your risk to reward ratio is 1 to 2, would you be A, in a profit, B, at 0, or C, in a loss? Okay. Tony, you're the third winner. Well done. Fast fingers. Fourth question, guys. Ready? As a professional trader, should you be A, glued to your charts 24/5, or B, forget the chart and get a life? Nicholas are the winner. All right, guys, are you ready? That's the last question, last $100 account to give out. So here it goes. How should you approach trading, online trading as a whole? As a hobby or a career like any other? Okay, let me just get the first one. Alex, you're the last winner of the $100 live with FX Pesa. Let me just make sure I get your details. Okay. Perfect. So guys, that's it. Our winners are announced. So let's have another, let's say 5 minutes break, and then we can continue for the last part of this webinar.